I want to go through some definitions. So I made a list. I gave this presentation. I thought it was my best job ever. I thought I did a great job. There was no one crying at the end, but it was close. And at the end, someone came up to me and said, "What's the S&P 500?" And I thought, if I would have just defined that, the presentation may have meant so much more to that person. So I came up with a small list, a short list of definitions of terms that most of you will know most of, but some of you might not know a couple of these. And just knowing what these mean, kind of having them in the back of your head will make this presentation more valuable to you. So listen if you know these, write them down if you want to, take some notes. There are different types of investments that we're going to talk about. One of the types of investments are stocks. I'll use another word sometimes for stocks. I'll use the word equities. Okay? The reason we call it equities is that when you own a stock in a company, you own equity in that company. You're an owner of that company. Okay? The reason equities are risky is because owners participate in profits, but they also potentially participate in some way in losses. And when a company loses money, its stock price goes down. Okay? So when I talk about stocks and equities, I'm talking about the same thing. Okay? The second one is bonds or fixed income. Bonds are safer, and I'm not just talking about government bonds or municipal bonds. I'm talking about corporate bonds. In our portfolios that we put together, people own stocks and bonds of the same company. It's just a different way for companies to raise money. One of the ways companies raise money is they sell portions of it through stock sales, right? You buy their stocks, you own their company. We just talked about that. The other way is they borrow money from you as an investor through bond issues. So they issue bonds, you buy those bonds, and essentially you're lending your money to a company. Now the reason bonds are less risky is that if a company is on rough times, who do they have to pay first? They have to pay their debts first, right? Owners of a company get paid after lenders to a company, all right? So bonds get paid first. There are short-term bonds and long-term bonds. If you lend your money to a company or to a municipality for a long period of time, that's a riskier bond, so you get a higher rate. If you lend your money for a short period of time, 1 or 2 or 3 years, it's a short-term bond, you get a lower rate. Okay, so we're going to talk a bit about bonds. Mutual funds are combinations of stocks and bonds. A mutual fund isn't just a combination of stocks or just a combination of bonds. A mutual fund could have stocks and bonds in it. So by mutual, we mean many different. And fund means you can own shares of one fund or one share. And by owning one share of something, you can own multiple stocks and multiple bonds. You can diversify that way. Does that make sense? So we own mutual funds. Now, there are different methods of investing. Those are investment types. There are different methods of investing. The two main types of investing are active and passive investing. Active investing is where you buy a mutual fund where the manager of that fund is actively buying and selling stocks on your behalf. Okay? You're going to find out that that's not the kind of investing that I advocate. I'll make a good case for it hopefully tonight. And then there's passive investing. We often call that indexing. We say indexing because an index is a kind of formula. And passive investing is where a formula dictates what kind of stocks or what kind of bonds are in a certain mutual fund. Active investing has a high turnover rate inside the mutual fund. Turnover is how many buys and sells the mutual fund manager makes. Passive investing has a low turnover rate because the manager is, again, a formula. It's not a person necessarily. A very common index fund or passive fund is the S&P 500. How many have heard of the S&P 500? Pretty common. And we're going to use it tonight to compare a lot of different things to. If you're in your 401k office at work and you're looking at buying into the market, one of the things that the person will show you is what the S&P 500 has done over the course of 15 or 20 or 30 or 50 or 100 years. The S&P 500 is one measure of the U.S. market. The S&P 500 is, in fact, the 500 largest companies in the United States. Okay? So the S&P 500 is just an index. You can own it as a fund, or you can just measure it as an index. We're going to be comparing a lot of things to the S&P 500 because it's a good measure of how the U.S. economy and market is doing, all right? Diversification is when you own multiple different kinds of companies or stocks and bonds. When you diversify, you own multiple different kinds. Risk is what we're going to talk about tonight. I won't go into that in too much detail. Growth or value companies. Growth companies are companies that are expensive to purchase. Their stock prices are high. Value companies are companies that have low price stocks. Used to call them penny stocks. Okay, so we'll talk a little bit about growth versus value companies. Large cap versus small cap. We talk about cap, which is a capitalization. That's simply a company that has a high value. What did they say? Apple was the largest company in the world for a while. Apple is a large cap company. And then small cap are very small companies. They're measured in billions or millions or hundreds of millions. And then one more, the Consumer Price Index. I'll call it the CPI, okay? The Consumer Price Index is a measure of the change in the prices of goods. We'll use the CPI, or the Consumer Price Index, as a measure for inflation. Everybody knows what inflation is. It's a buzzword. It's what we're going to talk about at the end tonight. Inflation is the rise in the cost of the goods and services that we need to live and exist and things we buy. So whether something is inflationary or not depends on whether the CPI or whether a country is inflationary or not, depends on whether their CPI, their Consumer Price Index, the index of the things consumers buy, is rising or not. Okay, does that make sense? So I hope that helps. We'll, there's certainly more I could say, but we want to make sure that we can do this in a timely way.